Welcome to Altus's U.S. State of the Market webinar. We'll be beginning shortly, but as we wait for others to join, we'd like to launch a quick poll to get a better understanding of who's on the call today. So if you don't mind, please take 5 seconds to complete the first poll question that you see on the screen. And again, we'll be beginning momentarily. All right, so hopefully folks are still completing the poll question, but we can get into it. So welcome everybody to Altus's US State of the Market webinar for the fourth quarter of 2023. I'm Omar El-Tarai, Director of Research at Altus. You probably can't see me right now, having a few technical difficulties, but we won't let that stop us. So this is Altus. We're a leading provider of asset level intelligence, and I'm very excited to be hosting two very impressive CRE industry leaders today as we discuss the macro forces, capital market conditions, and hear them share their perspectives on the CRE investment landscape. My two guests today are really at the fore of CRE investment, from interpreting macro and market forces to forming strategy and ultimately allocating capital. Both Adriana and Victor's perspectives really steer and influence billions of CRE investment dollars. On the call today, I'm pleased to welcome Adriana de Alcantara, Fund Manager for Hines US Property Partners, and Victor Kalanog, Global Head of Research and Strategy for Manulife Investment Management. Welcome both. And before we jump into the real meat of the webinar, I'd like to ask each of our speakers really to share a bit about themselves and their current roles. So Adriana, would you please share a bit about yourself and let the audience know what your scope of work looks like?
Omar, thank you. I'm very excited to join you all. I'm a partner and fund manager at Hines. Hines is a real estate investment manager. We have over 90 billion of commercial real estate under management, and we have almost 5,000 people across the world, of which 3,000 people are here in the United States. The last 3 years, I have been fully dedicated to the development and execution of our first flagship fund in the US. We launched the fund in July 2021. The fund is called the Hines US Property Partners. It's an open-end fund, it's core plus, and it's diversified. We invest in all property types, including alternatives, and we invest across the United States. We buy core properties that we can active manage. We do value-add properties, and we do as well development in the fund. It is Hines' main source of discretionary money in the United States. We have currently 26 institutional clients in the fund, and we're growing. I have over 23 years of real estate experience. Throughout my career, I held various positions, including asset management. I did acquisitions and fund management. And I work both in Europe and in the Americas. And I'm based in New York.
Fantastic. Thank you. And Victor, welcome. Can you please share with the audience a bit about yourself and your current role at Manulife?
Thanks very much for having me today, Omar, and I'm thrilled to be here with you, Adriana. I currently serve as Global Head of Research and Strategy for Real Estate Private Markets at Manulife Investment Management. Prior to joining Manulife, I was Head of Commercial Real Estate Economics at Moody's Analytics, and I was the Chief Economist at Reist, a third-party provider of data and analytics. So my current remit at Manulife, so I like saying, is having skin in the game, because now it includes not just assessments of the economy and local markets and forecasts, the kind of stuff that Omar is busy with, but it's also now how that impacts expected risks and returns for different property types, including what we may define as alts. So our current geographic footprint encompasses Canada and the US in North America, about 9 countries in the APAC region. If you include some of our real assets verticals, we have quite a bit of natural resource investments in the EU area. So that is a lot to cover. But the good thing is that the global economy and the policy environment has been so stable over the last 12 to 18 months that it's been a pretty easy job to anticipate change. No, no, no. I'm just joking, of course. Uncertainty continues to ride high across different measures. There's a lot to think about, which is why I think it's extremely timely to have a conversation like this one. So back to you, Omar.
Fantastic. Thank you. Yeah, so to that point, it really seems as though, over the last couple of years, things have changed quite dramatically. Pre-pandemic, and really only a few years ago, it seemed as though we had the luxury of focusing on slower moving but very powerful forces, whether those were demographic or technology or this decade-long kind of hunt for yield in a low rate environment. And while that yesteryear wasn't necessarily easy, right? I mean, I think portfolio managers were still very much having to put in a lot of innovation and ingenuity in terms of earning their pay. Compared to now, it seemed like there were way fewer uncertainties. And today it seems as though there are way more considerations that are necessary for any investment, but especially CRE, where there are so many powerful and important forces in flux, whether that is politics, look at it either domestically or internationally, monetary policy, a lot of that is getting rewritten, and I'd say we're almost in that experimental phase. Capital market and capital sources, those are becoming questionable, as well as down to the just demand and use of space. So I'm a lover of alliteration, and so I like to characterize the current environment as really one of several significant and simultaneous uncertainties. Victor, how do you make sense of today's investing climate, and which forces are you really tracking and trying to understand?
So is it several significant and simultaneous? They're all S's, and then uncertainty is spelled with an S and not a C. That was your alliteration.
I like alliteration. I'm not great at spelling, but yes, I'm glad you picked up on that.
All right, well, but thanks for the question, Omar. I appreciate it. I'm, by the way, just at the start, I'm really not sure things were ever as slow as we'd like to remember them to be. For those of us, I know Adriana and I really look like we just graduated from college 5 years ago, but for those of us who have lived through the great financial crisis, well, I mean, that was a bit of a mess too, right? So I think we tend to be neck deep in current crises, and then that colors our view of the past. Oh, everything was so much simpler back then, but I think that's rarely been the case. It is true, however, if you wanted to point out actual data, if you take a look at NCREIF's NPI components, income and appreciation returns, we actually do begin quite to see really quite the divergence starting around the pandemic years. You chart it out, 70s, 80s, thereabouts, you'll see property type NPIs moving more or less in a pretty coordinated fashion. There was some divergence in 08 and 09, and then boom, 2020 rolls around and hotel figures collapsed to historic lows. Industrial and multifamily hold steady, barely cross zero. And then you've got a recovery in 2021. Hotel ADRs hit historic highs. Significant parts of the market begins to question the long-term viability of office as an asset class. So fast forward to today's investing climate and what we're tracking, not to simplify things because the world is very complex, but I'd focus at least on two big drivers. One, this assumption that rates will stay higher for longer. I think it's a hashtag these days, higher for longer. Various forwards ranging from the effective funds rate to SOFR, it's all pricing this in. So what does this mean for equity and debt plays? If general cost of funds are higher alongside things like building costs, what does this mean for what we expect for opportunistic or dev funds? And what exit cap rate do we underwrite towards? If high yield credit now offers equity-like returns, what does that mean for allocation decisions? And if we're at peak rates, right, what risks do those suggest? Conditional on things like convexity in the bond market. So where are rates going? Have they reached their peak? And where will they land over your investment horizon, particularly things like your risk-free rate, which we all tend to consider, right, the US 10-year Treasury to be. So the second main thing that we're looking at is where to place bets when it comes to evolving data and analytic sources. I think we're going to talk about Gen AI and LLMs and applications to real estate investing later, but I think there's a lot of pressure right now that actually just this past year to answer the question of how is technology changing your investment process? And the cynical part of me goes, haven't we been through this before? I thought that graphene was going to change the world. I thought drones were going. What about crypto? Is that going to? What about, you know? So let's see. Maybe I'm a little bit skeptical. I want to make sure we think through how these things actually work. So yes, we are making bets on certain approaches and data sources and approaches to analytics, but we're all still, I think, admittedly trying to understand the approach that works best for us, for our shop, and for our investors. So back to you, Omar.
Thank you. Yeah, no, I think that you've just hit on a number of points that I hope we'll dive into deeper. But Adriana, are there any forces or risks that you think that the market currently has mispriced?
Yes, no, many are Victor already mentioned, but I wanted to get back to one point that Victor said already, that we look very young. That is important, right?
Yes,
I
it's the
stopped
most.
at 23 years real estate experience. That's it. But I have to say, I have a daughter that is 31 years old. So I let the audience make the math. So mispriced, inflation, right? Inflation, you mentioned interest rates. We are seeing a lot of problems in the office sector. We are all aware of it, but think about multifamily as well. The last 10 years, we had cheap money, and now it's not only interest expenses, but as well operating expenses going up very, very fast. And we're seeing an increase, many multifamily properties in trouble right now. And one additional point that no one is talking about, the last 10 years, products like credit lines or subscription lines, they became really very popular with large funds because it gives you, it makes fast, right? And the low rate environment made these products popular. But what is happening right now is that in the office sector, several funds, they don't have property debt. They have credit lines. What that means is that they are probably going to be forced sellers, and their risk is not limited to the equity piece, right? Several people, you were talking about NCREIF or Odyssey. I have heard many people saying that office in Odyssey is probably going to go lower to 10%, more or less like retail is right now, right? I don't know if this is going to happen, but it's already at 20%. Not for long ago, it was 36% in Odyssey.
Yep. So
inflation. And then labor is the other point, Omar, that I think it's a little mispriced as well. Unemployment rate is really very low, but think once again about multifamily. It is so hard to keep the property managers in our properties because they keep changing to the next property, right? So labor is important, and it's making development as well, pricing go up. The budgets are going up as well. And the last and not least, climate risk. I'm sitting actually today, I'm in Miami, Florida, insurance costs 3 times. A lot of multifamily deals are not being closed because of insurance. It's not that easy to underwrite it, but for 2 years ago, it was more or less $700 per unit. Now it's well over $2,000 per unit. So that is going to be interesting as well.
Adriana, can you repeat that? From 700 to 3,000.
700 per unit to now over 2,000.
2,000, over 2,000. Okay. Wow.
Right. That is significant, right? About taxes, but as well, operating costs are going up really very fast.
Wow. So I'm hearing a lot of pressure, not only, or there's a lot of uncertainty, not only in the broad macro environment, which Victor, you pointed out, and I appreciate the context, right? Like if you do take a long enough time horizon, or at least look historically, maybe the level of uncertainty that we're facing now is not necessarily abnormal, because we're always facing uncertainty, but the way that it's playing through the system, or where we currently stand, I was hearing a number of financing concerns. Adriana, you pointed out the credit lines, as well as a lot of, I would say, operational concerns, whether that is the people or the individual kind of cash flow line items that that whether that's in the shape of insurance or property, having good talent there just to keep running your assets. I think we're going to launch another quick poll to see how the audience feels about what the risks that they've seen in CRE. So if you have a moment, please answer the question that pops up on the screen. But then trying to dig in a little bit deeper, and I know we've discussed the challenges that the macro backdrop have presented. I'd love to get in a little bit deeper to how you're situated and how you're operating and navigating through. So Adriana, what are the big questions that you're trying to answer, either with your existing portfolio or when considering new investment?
Okay. Yeah, with the existing portfolio it's always back to basics. Actually, what I find normal, right? It's all about the cash flow. It's about the service to the tenant. When people ask me how many people Hines has in the US, and I say 3,000 people, people comment, oh, okay, but a lot of that are property managers, engineers, and facility managers. And I say, yes, it is true. We have a lot of engineers in the US. We have a lot of property managers. We actually have over 1,000 engineers in the US. But this is, to me, and has always been, the most important people. They are on the day to day. People talk very lightly about sustainability, technology, innovation, but you need the people to implement all this. So that these people are the most important to me. I have seen so many times a lot of investors spend a lot of money in state-of-the-art equipment, and then their property managers, they don't know how to operate equipment. That is not money well used, right? And then in investment decisions, same concept, back to basic. It's about the location. It's about the quality of the assets and diversification. My fund is a mark-to-market fund. And obviously, the other thing that I think is that everything that I'm buying today needs to be valued at least at cost or higher than that the next quarter, right? But yeah, these are the points. Just one additional point that I think is super important. I think about probabilities in this market. We all can make mistakes. It's very easy to make mistakes in a market environment like this. Same as back in 2009, right? So I rather go buy smaller property types. The mistake you can do in 100 million property, 10% is 10 million. But if you buy 500 million property, 10% is 50 million. That could be a big mistake. So that to me is very important as well.
So managing concentration through overall investment size. Is that correct?
Yes, that's correct. Diversification. Mm-hmm.
Fantastic. And Victor, as head of real estate research and strategy, how would you describe your process for investment idea generation and thesis building? And is that evolving at all?
Thanks, Omar. Now we've adopted what I'd call a disciplined approach to investment idea generation and thesis building. And what that means is that we combine a top-down perspective. We want to evaluate overall global, national, and local economic conditions, and you want to figure out income pricing, overall return benchmarks we should realistically adopt. But we should never forget that bottoms up view, which I know Adriana had referenced as well. For folks in the front lines, we always work very closely with our asset managers, heads of transactions, portfolio managers to figure out how we should tweak that top down view to really reflect local market reality. So basically, it involves a lot of talking and coordinating, and it's certainly not beholden to out of box results from fancy models that I might happen to create. So, for example, we're closely monitoring where office occupancies are headed. I know Adriana basically said, yes, in Odyssey, we might reduce allocation to 10% down to 36%. That is certainly a trend, right? But it is so different across geographies. We might be stuck in the high 40s in terms of physical occupancy in North America, but Asia's numbers are 30 to 40 percentage points higher than that. They're basically back in the office almost 4 or 5 days a week. And so we're trying to be nuanced as possible when it comes to building things like our house view and how quickly we should adopt that to changing market conditions. I'm not a big fan of change for change's sake. It needs to be methodical and it needs to have meaning to it. I like what Adriana said about, sometimes you have to go back to basics. If it's really, really hard to put a number on valuations right now, that doesn't mean you shouldn't. Maybe you take a look at the actual cash flow from these income generating properties. That's a basic premise for real estate investing, right? That it's actually an income producing property. So it requires a lot of talking, but actually more importantly, and I think people forget this a lot, it requires a lot of listening. So I think it's a benefit that I speak a bunch of languages. I know Adriana and I can switch across at least 3 and hopefully elicit more candor and honesty from our stakeholders in the front line, right? And I think that's something that a lot of folks take for granted these days. It's not just your expertise in the field. It's really how are you able to elicit truth from the folks in the front lines, particularly if your platform is outside North America or English is the lingua franca, right? And so I think the more we communicate, given these uncertain times, hopefully it all redound to something a little bit better tomorrow. Back to you.
Fantastic. And I know one, oh, sorry.
No, thank you for saying this about the diversity as well, right? Because I need to constantly take decisions. And I have my team is super diverse. I have a lot of people in the team and very diverse team. I take all the opinions and I listen to everyone. Well, my opinion can be wrong, right? But at the end of the day, I need to take a decision that helps a lot when you have a diverse team. Very important. Thank you for saying that.
It also means a lot of fights sometimes, right? But I'd rather that we have it out in the open because you're already thinking that. You're already thinking something different. And if you can't express it, because I know these are all buzzwords these days, right? Inclusion and making sure that but it's really that. It's like, do you feel safe in this space so that you can raise your hand and say, I'm not sure I agree with that. Let's talk about it. Ultimately, Adriana will be the leader that says, all right, I get it, but this is where we want to drive the bus, right? So that's strategy. This is where we go. This is where we don't go. That's why folks like Adriana are in a role. But man, we need to like listen to all these diverse perspectives. Hopefully it means we don't run into a car crash because if enough people are saying we probably shouldn't go there, I don't know, maybe we should listen, right? So back to you, Omar.
And through this listening and through the eliciting truth through conversation, I really like that, and really hearing the different perspectives that perhaps you either don't fully appreciate on the surface, or you may have your own stand and disagree for various reasons. I know one of the topics that the industry as a whole is trying to digest is really kind of tech and AI. I know that that's an area that there are either some very strong opinions on either side. But is that something that is coming up? Is that something that you're discussing, or at least hearing perspectives on?
Do you want me to go first?
Sure. Yeah, Victor. I guess. Yeah. What's your perspective of AI?
Now, I don't know if you could tell, but I'm a big geek, and I love this topic. It covers so many of my interests, all the way from sci-fi and books to CRE investing. So, just as an historical perspective, I do want to share that versions of AI have been around for some time. I'm proud to share, for example, that more than a decade ago, I helped introduce with our team the first NLP, natural language programming applications for AI in commercial real estate, where the platform our team put together at Reese auto-generated narrative analyses for over 2,000 markets and submarkets, including property level comps analysis, which would change dynamically when you select or deselect assets in your comp set. So the narrative report changes, which is what we expect human analysts to do, but we were actually able to automate that. I think what makes today's applications a bit different is that modern LLM, large language model platforms have really done well to basically anticipate what the next logical outcome or result ought to be. So whether it's Google auto-completing and anticipating what you're searching for when you type things like, try this, by the way, the Fed will decide to, just type that in Google, see what pops out, right? Check out the results. Or you've got Chat GPT following a well-framed, and this is key, you gotta prompt it properly, a well-framed prompt to use Python packages like Folium to create interactive maps with building data. I think modern AI does offer more opportunities, and we need to be precise about this, to increase productivity. Now, that's different from true innovation. AI at this point has the potential to take many parts of our existing processes and automate certain steps, increasing productivity. But will that translate to actual innovation, the new introduction of products and processes that represent a real quantum change in how we do what we do? I think that remains to be seen. So there's a push and pull here. Innovation sometimes tends to be incremental, because often we don't trust change that comes too quickly. Adriana, I love your example about, oh, well, you'll buy the latest technology, but guess what? The humans who are expected to operate them might not operate them to their full capacity and capability. And then that's a bad investment, right? Almost the entire, well, we're not going to get into country histories here, but there are developing countries that tried to do exactly that. They imported capital from developed countries. Guess what? It broke down because the humidity and heat in those developing, the humans just didn't know what to do to operate it when these things broke. And so let's bring it back to CRE. Say I approached you for funding, right? And I told you that our investment decision-making process, which you asked about earlier, Omar, was entirely AI driven. And that at no point as a human analyst double check or battle test the recommendations. Would you write me a check? I guess that depends on past performance, right? And right now we have yet to accumulate, honestly, enough data points to really properly evaluate so-called AI-driven investment approaches. So again, in my mind, great potential for productivity, open question as to its net effect on innovation in CRE investing and on the economy as a whole. We are experimenting with a whole range of applications, and that's fun. But at some point, we're going to have to decide whether concepts get translated to actual uses. Back to you.
But Victor, there's already some innovation. I mean, you're talking about AI and bots. We use a software in for our multifamily that is called Meet Elise for our apartments. So it's a bot, okay, that you send a request to lease an apartment, and Meet Elise. Elise responds to you. She.
Oh yeah, I read about that. You guys use that?
Yeah, we use that, and sometimes I actually try to lease apartments in my properties to see how it works, right? So, and because it has been going on for, I think it's over 6 years now,
Yep.
It has learned so much. We have a lot of people coming to our properties and say, hey, I want to speak to Elise.
Yep.
Yeah.
And they
become
think it's a real
friends with
person,
Elise.
right? They
Yeah.
actually think it's a real person, right?
Oh,
Yep.
yeah. Yeah, they become friends with Elise. You can have a real conversation with Elise. So no, there's a lot of innovation in this sector. Sorry, Omar, I didn't mean to. Yeah.
No, and I know that
Interrupt you.
in the prep you had mentioned that you're looking into data centers.
Yep.
Is this something that you could speak to some of the characteristics and maybe the profile of that property type that are attractive, as well as some of the areas that you're looking to better understand?
Yeah, sure. By no means I'm a specialist. I'm learning as well. Okay, but no, we are looking at data centers. We don't have any data centers in my portfolio yet. In our portfolio, we don't have it. We did do in Europe already, but at Heinz we have developed and we have managed data centers. So basically there are three, and I'm going to read it, but there are three types of data centers that we're looking at. The PowerShell data centers, that is when the landlord owns the data center, and then the tenant, they build and maintain the infrastructure. The second one is co-location data centers. You have multiple tenants renting the space. It looks like that's really to me, the most interesting one. And the third one, which is obviously very interesting, is hyperscale data center. That is really for large tech companies, Google, Amazon, you name it. But here, as I have been learning a lot about the sector, once again, a lot of innovation. One of the things that data center needs is cool air. But we are seeing data centers in Phoenix. Obviously, Phoenix is not a very cold place to be, right?
Yeah.
But innovation, there is liquid cooling that can do that. So there's a lot of innovation in the space. According to Green Street, and we use Green Street a lot, data centers, the sector is going to grow the most from any other sector in the US. By far, in terms of location is key. Power is key. By far, Virginia is the largest market in the US, but there are many others like Portland, Silicon Valley, but the key is access to power. Yeah.
Fantastic. Yeah, it's an area that I'm trying to better understand myself because, Victor, to your point around AI as a tool, right? I really think of it as it's like any other tool, right? Where there's, a hammer can be used to drive a nail, or a hammer can be used to, you can break your hand using it. So AI by itself isn't necessarily, the solution or the end, but I can totally see the, leverage or kind of the wide application across various sectors. And Adriana, to your point earlier around some of the pressures that commercial real estate experiencing is with certain, I would say, efficiencies or cash flows that are used or that are really that could benefit from efficiency. Maybe, insurance and climate risk, maybe not, but the application that you just noted in terms of interaction with tenants and residents is huge. And so I think that there could be big growth here, but at the same time I would I echo that kind of like skepticism of seeing how it alone could change the CRE landscape. And we'll just launch the final poll to the audience here to get some of their perspectives on AI. And then before we go into the last section, which I do think I'm most excited about this section of the call, which is really focusing on the future. It's early fourth quarter right now. The weather's getting chillier. Earnings just kicked off. So I feel as though it is kind of that right time of the year for forward glances and outlooks. It's really my favorite season of the year. But before we dive into the outlooks and a glance at what 2020 2024 may hold, I'll quickly contextualize kind of where we're coming from, right? So we entered 2023 with the backdrop of inflation at 40-year highs. Fed was hiking and really not slowing anytime soon. Broad equity markets were down nearly 20%. Treasury yields were up more than 2.5 times, and you saw similar, yield increases across the corporate sector as well. And you hadn't really seen these types of, yield movements since the global financial crisis. And this really led many across commercial real estate, as well as just the broad capital markets, to believe that 2023 would be the year of what they then dubbed the most anticipated recession on record. And yet here we are in October and still really no recession, right? So inflation is down, but not quite tamed. Futures market is still showing that many in the market still expect that the Fed may increase rates again this year, before the end of the year, even though I was just looking at those probabilities. They've come down quite a bit over the last couple of weeks, but an additional rate hike is not fully off the table. And while markets are in the green on the year, they really have yet to recover all of the ground lost in 2022. And the markets are still filled with a lot of uncertainty. Now, relating that all to commercial real estate, Victor, how have your perspectives of the market really changed over the last 12 or 18 months? And what's your current outlook for the next 12 or 18 months?
All right, thanks, Omar. I think this has indeed, by some measures, become the most forecasted recession on record, right? So to be fair, it's still not here, at least for the US. Although, to be fair, I also believe that Canada may already be in technical recession right now. So I think the last 18 months has really challenged a lot of our assumptions about what monetary policy could accomplish without expected trade-offs. Could the Fed really achieve price stability by raising rates without sacrificing full employment? Answer, you know what? They've been pretty lucky so far, haven't they? Our view is that the Fed is at or close to its final rate hike, given recent trends in inflation, although they'll never tell you that. That does mean that over the next 18 months, we should expect, I think, a couple of things. I'd love it if Adriana and Omar, you guys weigh on this. Well, first, when you've got like CRE benchmarks, like the 10-year treasury, that usually uses our risk-free rate, right? They've produced quite a bit of hair pulling, especially over the last couple of weeks, particularly when it began breaching the 4/8 range about a week or so ago. You can't imagine the questions that came my way, right? But historically speaking, what ends up happening is that we should expect a 100 to 150 basis point decline in this key measure over the next 12 to 24 months if we are at the peak of our hiking cycle. So even if we encounter a recession, however, there is a floor to how low the 10-year treasury can go, because then the yield curve will resume its, sorry, this is a super nerdy term, but a monotonically upward slope. It's not gonna be inverted anymore if we encounter a recession, right? So if the Fed sticks to its expectation that the long-term overnight borrowing rate should hover at or around 2.5%, then that is your higher for longer situation right there. The second thing that I think we should expect in the next year or two is we still expect a little bit of repricing in private CRE markets. So if you examine public CRE price indicators, take a look at REITs in the US, 237 of them or so, and you calculate implied cap rates, then public CRE markets are trading at around a 10 to 20% discount versus private CRE prices. Now, this is the big if public CRE markets have bottomed and REIT prices have kind of stabilized pretty recently, and they're a leading indicator with a lag of about 6 to 12 months, then private CRE cap rates may still rise, therefore, by some amount, more perhaps for a property type like office and less for sectors like multifamily and industrial, where I think we can all agree that demographic drivers do remain favorable through the cycle. So I can talk about this forever, but I really would prefer to listen as opposed to talk. So back to you.
I honestly could listen to you talk for maybe not forever, but many hours, right? Like that. I've been a huge fan of your work over the years, and this is I would love to just hear an hour of you just spilling your thoughts. Adriana, where do you have the most conviction in the current market, whether that's a specific market or geo or even property type? I know that you're so much of your job is building that conviction and putting capital to use. So looking forward, what has your attention and your conviction?
The living sector, industrial, and as I mentioned to you before, alternatives. And alternatives can be data centers, medical office buildings, and self-storage. Multifamily apartments and student housing, the first one, it is going to be, as I was saying before, it's not going to be an easy 2 years. I do think that as Victor was saying, I do think that rates are going to remain high for a little longer, but there's a housing shortage in this country. So over the long term, I feel that apartments are really well placed to outperform the market. Industrial, the market, the fundamentals are still really very good, but it obviously depends where you're buying. If you're buying high barriers to entry market, dense locations, and close to airports, close to ports, or even close to labor, I think you're going to do well. As an example, I do like San Diego is one of the markets that I like the most in the U.S. for industrial right now. We have properties close to the Mexican border in Otay Mesa that is doing really well. And as said, the last one, all the alternatives. What is interesting with the alternatives, and all of them actually, they do well when the market goes down as well. Tenants, they are usually sticky. We're talking about data centers. Because power and location is so important, tenants, they end up being really very sticky. And it's very similar to medical office buildings as well. So these are really my high conviction sectors, Omar.
Fantastic. And I know that as rates have changed and pretty much repriced the entire capital stack, have you seen greater opportunities to play, in different roles throughout the capital stack, Adriana? Is that something that you're looking at all, or no?
You're talking about mass pref, and that's what you're talking about? Yeah. Yeah, sure. We look at that as well. But I'll start by saying that on the equity side, for 6 months ago, I would say that investments with 6% plus cap rates were unusual. Now we start to see several of them. I don't think it is unusual anymore. And we're seeing more and more deals coming back. Obviously, cash is king. I think that the wild card is going to be office, and not all office is the same. The flight to quality is really real. The best office is doing so well. It's so different from B and C class C office. There's a big difference. But I would say as well that everyone is talking about work from home, but the reality is that we built too much office in this country. So we have to go through this supply imbalance right now. Very similar to retail for 15 years ago. Everyone is talking about, oh, retail is coming back. Yeah, sure. We didn't build any retail in the last 15 years. It's coming back. It is doing much better. But yeah, I'll leave it at that, Omar.
And Victor, do you have any views on how the capital stack may change either in the short term or potentially longer term, solutions for financing?
Yeah, so I'll maybe answer that in a somewhat oblique way, but just think about this. Depending on how you measure it, and it's quite like structurally regular, it's stunning. Whether it's 100 years or maybe 20 to 30 years, when you got equity indices like the S&P 500, they'll typically return about 10% per year, right? But because of pretty recent trends, we're looking at some debt instruments, particularly high yield, they're giving similar returns. So now you have debt options with equity-like returns. And we're going to have to think very carefully about what that means for our allocations and investment decisions. That is not a wholesale endorsement for debt at this point in the cycle, because if we're expecting interest rates to decline soon, that does represent risk to debt investments, depending on the usual bond math considerations revolving around duration, right, and convexity. So that's a forward-looking view, but make no mistake, current conditions are such that there's a massive demand for credit right now. You've got $2.6 trillion of maturities coming due in the next 5 years, 44% of which are multi and about 17, 18% are office. So there are plenty of opportunities to have conversations around what I'll call, and I think it's what Adriana is describing too, creative capital approaches, shall we say. Back to you.
Fantastic. And I guess given your phenomenal experience, both of you have great track records that span multiple decades, despite the I think your personal routines that make you look like you're fresh into the labor force. If somebody were starting their career today in commercial real estate, but had all the wisdom that you've gained, what would you recommend that they do? How would they steer? And what advice would you give to somebody who's starting out in commercial real estate today?
Oh,
Adriana, go
for
first.
sure. Networking for sure. I mean, I was the last, well, we were talking about this, Victoria and I, the last 2 weeks I was in Europe. I obviously went to the expo, a lot of people there, just exchanging information with people. That is so important. And I have so many friends from, I don't know, 20 years ago still that I know that I give them a call, they will help me. That is super important, right? And then be humble. The market, well, if you're not humble, the market will make you humble, right? It's really very difficult to outperform benchmark. Yeah, I would say these two things: be humble and networking.
I love that. And Victor?
Omar, I'm really not sure I'd attribute a lot of this so-called wisdom to me at this point. Maybe that's indeed part of becoming wiser, right? To be more hesitant to call yourself wise or even smart. I think so. I think we learn a lot. I think we learn the most when we're challenged. And there's no shortage of challenging times for CRE investing right now. My favorite example here is if you've ever joined the spelling bee contest and you lost, you always remember the one word that you misspelled, right? Do you remember the ones that you got right? No, you remember the ones that you got wrong. So if I were just starting my CRE career right now, I think I'd try to find opportunities where teams, businesses, and folks seem to be dealing with complex challenges. So practically speaking, that might be servicing in CMBS loans when they encounter distress. That might be in fundraising, given how challenging it's become to raise funds in the current environment. That might be in acquisitions where you have to figure out, oh my God, where are cap rates headed for your exit assumptions. That might be in data science, where the challenge is to determine which of these so-called sexy new tech approaches will actually work for CRE investment decisions. So try to learn, I'd embrace the opportunity to contribute and to help. And then most importantly, I try to keep learning and getting to know not just how the business is done, but more to fundamentally, I think, how to get things done. I guess that's not so different from what I tried to do back then and what I continue to try to do today. When there's a problem to be solved or a challenge to overcome, I want to be the person who will say, okay, let me figure it out. Hold me accountable. I'll help us get things done. And I think that if you bring that kind of positive can-do attitude to your career or any endeavor, you'll be pleasantly surprised at what you're able to contribute. And then people begin trusting you more because you actually delivered. And then success usually follows contribution, but not always. But I've always, I guess, focused on the value that I help create by trying to do this, and then that contribution that I help provide. Back to you.
And I actually think you're definitely right. People usually they don't want you to fail. Everyone wants to. When I go to client meetings, as an example, I know that they want me to do well. People want you to do well, so don't assume that people are thinking, oh, this person is going to fail. No, people they try you to make a better job. Yes, I do think so.
Well, I would say that what you've shared is absolutely wisdom, and I'm going to be trying to put that to practice. So before I thank you and give a few minutes back to everybody, I do want to give a quick programming note on a few upcoming Altus events. We currently have a commercial real estate conditions and sentiment survey that is live that I encourage everybody to participate in, as well as on November 7th, we have the NCREIF Odyssey Index Q3 2023 analysis webinar. Encourage you to sign up for that, as well as we have the CRE Exchange podcast, which is a bi-weekly podcast that we produce. And then also this webinar will be available for replay. So in case anybody wants to rewatch or to share it really with your colleagues and connections that weren't able to participate live, you'll be able to find all of that on the site. Otherwise, reach out and we can provide you with all the information on any of those events above. And with that, Victor, Adriana, thank you so much for really sharing your time, your perspectives with me and everybody on the call today. I'm sorry that we couldn't get the camera to work, but you're not missing much with my face. So I hope you have a really great rest of the week and a strong fourth quarter and next year. So thank you very much.
Thank you.
Thank you.